Welcome to REITs in a Post-COVID Landscape, a 4-part webinar brought to you by The Edge Singapore. The series is sponsored by Elite Commercial REITs.
Hello again, everybody. Welcome back to The Edge Singapore's REITs Investment Forum titled REITs in a Post-COVID Landscape. Yesterday, we had Vijay Natharajan, real estate and REITs analyst at RHB Securities, sharing with us on choosing the most COVID-resilient REIT. Our next speaker is Mat Oakley, Director of Savills, who will speak on the topic Commercial Property, A Tale of Two Cities. Unlike the Dickensian novel, Matt's topic will be a sort of primer on UK commercial property and highlight, where necessary, the differences with Singapore in terms of lease structures, tenant risk, break clauses, renewals, and so on. Please go ahead, Matt.
Thanks, Gula, and it's a great pleasure to be joining you all today to talk about the UK commercial property market, talk about why international investors, and particularly Singaporean investors, have been active in the UK for many years. Obviously, we're facing quite significant challenges. Some of them are unique to the UK, some of them are global, but again, I'm going to try and chart a path through those and identify some opportunities as well as some risks in the market. One of the things that I think many international investors don't necessarily realise is how popular the UK is. We're a relatively small country, relatively small cities in a global context. But if you look at these two tables, the one on the left shows non-domestic investor flows into various national markets. The one on the right shows into various cities. You can see that over the period 2018 to 2020, the UK has been the fourth most popular destination for cross-border investment across the planet, and London has been the first. Actually, London has been the most popular destination for cross-border investment into real estate for all of the last 10 years. So this begs the question, really, of why do international investors like London and the UK so much? There are some things that are often discussed in the market. I'm not totally convinced that these two are big drivers, but they will things you will hear. Certainly, I think the world's real estate investors recognise that the English legal system is fairly safe and fairly stable. Indeed, many people's legal systems are based around English law anyway. Language and familiarity, again, not necessarily things that are massively important, but they just help. Most international visitors to the UK were perhaps taught English as their second language. Many have visited the UK, been educated in the UK, or educated their children in the UK. And these things all build up to developing a slight degree of trust in investing in the UK. I think when we get to the really important factors, this is one of them. Unlike many international markets, most notably the USA, non-resident investors in UK commercial property are taxed exactly the same way as domestic residents. We treat all investors the same, so there is no sort of punishment for being an international investor into commercial property in the UK. The situation is slightly different for residential. I think these are also very important, particularly if you're coming from very far away and you're not building up a significant portfolio in the UK, transparency and liquidity. Many international investors, they like the comfort that, this is a market you can sell out of, even in the depths of a downturn. So London offices in particular, the market never goes completely silent, even in the worst national or global downturn. So if you need your money, you can get it out. Transparency is also really important, we find, with international investors. And there are an awful lot of people like me, property researchers, who put out an awful lot of market data and analysis. And you can say you can be absolutely sure that what you're being told is true, because you can check it against a variety of other sources. And you can be pretty sure that the pricing is also pretty transparent. Most deals get publicized in the market, so you can really understand that you're paying the right price. We also have a very liquid debt market. Many international property lenders are also based in London, so the bank that you may be used to operating with at home probably has a branch in London. And we have around 200 to 250 property lending organisations in the UK at the moment. So while the debt market is probably not very liquid at the moment, when it is liquid, there's a lot of choice out there. Again, it's perhaps slightly playing to the transparency point, but Commercial property is a regulated organisation, a regulated sector in the UK. The Royal Institute of Chartered Surveyors regulates the behaviour of your professional advisors in the same way that accountants and lawyers' behaviours are regulated by their own organisations. It is very easy to go and look up and say, well, what are the rules on how my real estate will be valued, and be absolutely sure that you are getting the same treatment as other players in the market. And again, this is very important for investors who may not be based in London, they may not have an operating office in London or the UK, they are just coming here occasionally. You need the comfort that your professional team are operating professionally. And then we have a whole string of factors that are specific to UK real estate assets. And I think this is a really important one. In a global context, the kind of lease length you would get in the UK is quite long. Typically, lease lengths on many types of property, most notably offices and logistics, are in excess of 10 years, sometimes 15, sometimes 25. This gives investors a real sense of income security, particularly when you add in the fact that we have what is called the upward only rent review. Now, I've put upward only in quotes here because it isn't quite true. It just means that, say you had a 10-year lease, at year 5, there will be an opportunity to review the rent. That is reviewed against market evidence, and if both parties can't agree, it goes to arbitration by the RICS. The rent doesn't have to go up, but it cannot go down. So this means that if you're owning an asset, a commercial property asset in the UK, you can be certain that unless the tenant goes bust or leaves, for the whole of your, say, 10-year lease, you will get the same rent that you were being offered at the beginning of that 10-year lease, regardless of if the market rents have fallen. They cannot go down. And again, for non-domestic investors, this is a huge degree of comfort. Something that is also comparatively unique to the UK commercial property market is the full repairing and insuring lease. So virtually all the costs associated with maintaining the building are the tenant's problem, not the landlord's problem. So if you buy a nice office building in the UK, you will pay your professional advisors, you will pay your transaction taxes at the beginning, then you will pay someone to collect the rent for you, and that is really the only cost that you incur thereafter. So it is a relatively fire and forget asset, a triple net, if you like it, in the US context. And finally, there is a breadth of assets. We find many international investors prefer freehold. Those are relatively scarce, but they do come up in most markets and most sectors. Most of the UK, is sort of leasehold assets. But again, there is the full spectrum. So putting all those things together, you can see perhaps why the UK is so popular with international and indeed Singaporean investors. Now, it's not all positive, and it would be very wrong of me to say there are only good reasons for investing in the UK. Things to be aware of when you're investing in the UK, things that are relatively unique. First of all is that London dominates. Many investors coming from sort of big global countries with lots of big cities are surprised by how London dominates. London dominates the UK economically. London dominates the UK in terms of investment activity. Typically around 50% of all the commercial property deals that take place in the UK take place in London. The markets outside London, therefore, are relatively small and relatively illiquid. There is only one city outside London that has a population of more than 1 million people. So many international investors find it challenging to go out of London and into the UK regions. But actually those who have done so in the past find it a less competitive space and potentially more fruitful. But it's something to know. Also, I think you need to be aware the real estate markets in the UK, for a variety of reasons, are highly volatile and highly cyclical. Unlike perhaps a market like Germany, where there is relatively little volatility in rents and capital values, in the UK, it is not uncommon to see swings from sort of plus 25% in rents or capital value growth to minus 25% in the space of a couple of years. This is because it's a highly liquid market. It's a very well understood market. It's a market where there is significant degree of expertise. investors and tenants tend to react quite quickly, but you need to keep your eye on the UK market. And that is one of the reasons why we have this long lease. To a degree, it insulates investors from some of that volatility. And, Brexit remains a challenge. Sat here today in early November, theoretically, the UK is exiting from the EU, or the end of the transition arrangement between the UK and the EU is the end of this year. There is still yet to be an agreement between the UK and EU on trade. Some of our international clients see this as an opportunity. They're actually hoping for a disorderly Brexit and potentially some price falls. Some of our clients are just choosing to wait and see. They're going to wait till sort of early next year when they know what has happened with Brexit, and then they're going to deploy their capital. So you have to take this into account. It will affect the market in some way, shape or form. So where are we today in terms of the markets and their cycles? I think we're facing some new questions and some very old questions. We're in the middle of a recession. This isn't unique to the UK. It's a global problem. And we have to ask ourselves the question of whether the impact on property will be really any different to a normal recession. I've mentioned Brexit. That is another factor coming into the equation. And I think, we're starting to ask the question of what sectors and property types normally recover first out of a recession. Generally coming out of a recession, again, this is not unique to the UK. We see investors going towards a risk-off approach. This tends to favour relatively low-risk assets, CBD offices, logistics, multifamily housing, always rise in popularity as we come out of a recession. And we see, less interest in development, retail, hospitality coming out. No real signs that anything particularly different is happening here. While there's a lot of talk about the new normal post-COVID, we're yet to see that having much impact on the markets. And I'm not hugely convinced that rolling the clock forward 12 months, we will have seen a lot of behavioural change. However, at the moment, it's very important because office workers are not returning to their offices in the kind of numbers that perhaps the government and their employers would wish they did, at least before the current UK lockdown. More on that in a moment or two. So generally looking ahead, I think we are looking at a very typical story, very similar to the shape of the recovery coming out of the global financial crisis or the dot-com crisis, or indeed the early 1990s recession in the UK. Investment markets will recover strongly. I expect investor confidence to come back quite strongly in the beginning of next year. We're already seeing a fairly sharp increase in international investor interest and activity in the UK, despite the difficulties of travelling cross-border. We are seeing some short-term hits to pricing, but I think there isn't much distress in the market other than in the retail space. Those investors who are hoping to see sharp capital value falls as a buying opportunity are not finding them. On the occupational side, occupiers tend to be less sentiment based than investors, so I don't think the recovery in occupational demand will be quite as quick as in the investment market. But the UK economy is expected to show have shown record levels of growth in the third quarter of this year and into the fourth quarter. And I think that will start to lead to a pickup in occupier confidence around the middle of next year. But it's going to be a relatively slow recovery and very sectoral based. All of that depends on economic growth, and what you have here is a consensus of the top sort of 50 to 60 economic forecasters around the world on the prospects for various GDP growth stories. And you will see here in the highlighted segment of the chart, the UK following a very, very similar pattern to pretty much every other economy around the world. A very nasty year this year, a strong recovery next year in GDP growth, but not quite as strong as the downturn. There were a lot of people hoping for a sort of V-shaped recovery. It's not quite that good. And there are a lot of dragging factors on economies around the world, not least the fact that unemployment is going to continue to rise into next year and take 3 or 4 years to come down to where it was, as well as the cost of the government spending on sorting COVID-19 out. So these factors will lead to a slower recovery than perhaps we're used to coming out of recessions, but there will be a recovery. And commercial property is a really simple asset class. When the economy is growing, we need more shops, offices and factories. When it's not, we don't. So economic growth, really, really important. When you're looking at the UK, these are forecasts for the next 5 years at a UK regional level. Again, a very similar story to what we've seen coming out of prior recessions. Greater London will show the fastest growth, the southeast, the market around London that is very closely linked will show the next fastest growth. And then the rest of the UK region showing relatively similar growth rates. Not quite as simple a story as saying the closer you are to London, the better it is. But generally, that is a reasonably solid story. The regions that I would pick out, and again, within some of these regional figures, there are some very, very strong regional cities in the northwest. Manchester is expected to grow very strongly. In the Midlands, Birmingham is expected to grow very strongly. And in the southwest, Bristol is expected to grow very strongly. But it is a very typical pattern of recovery for the UK economy. And a very typical story when you talk about what's happening in the commercial property investment markets. And what you have here is commercial property investment volumes in 2020 in the left hand of the two bars, and the 5-year average for that month in the right hand. And you can see that, very dramatic slowdown in market activity as the first lockdown hit in March into April, May and June, substantially lower than normal. July and August, not quite the recovery we were hoping for in investment activity, but then September and October, coming to within around 20% of normal levels of activity. The UK does tend to be relatively back-ended in terms of the year, with a lot of activity happening at the end of the year, as you can see in that December bar. I'm afraid to say that probably isn't going to happen this year. I think the dragging effects of Brexit negotiations on confidence, as well as the fact that the UK is in a less strict lockdown, but we are still in lockdown until early December. That will mean that we're not going to see this sort of fourth quarter bounce that normally we would get, but clear signs that investors are becoming more keen on the UK, more normal levels of investment volumes happening. For those of you who haven't looked at the UK in advance, the trends in terms of where people are putting their money are very similar to the global story. And this is looking at the proportion of UK commercial property investment, what went into what type of assets. And the real story of the last 10 or 15 years has been a steady decline in investor interest in retail and leisure assets. As you can see, they've gone from 42% of the total to 15% of the total, and a steady rise in alternative asset classes. And these would include data centers, multifamily housing, seniors housing, student housing, various other things in that segment. So, investors definitely are swinging away from investing in retail. That primarily is because the UK is probably one of the most advanced nations on the planet in terms of the adoption of internet retailing. Around 20% of UK retail sales are now online. That's certainly the highest in Europe. It's higher than America. And we're just seeing that story of a reducing demand for shops, an increasing demand for logistics, playing into investors' behavior. We haven't seen a dramatic increase in the amount of money going into industrial logistics, but we have seen significant moves in pricing. I don't expect any of these trends that I've just discussed to change in the next 3 or 4 years. I think offices will remain the single largest segment of the market. Alternatives will remain incredibly popular and be the second. Retail will pick up a bit, but not a lot. So just touching on some themes that are affecting the occupational markets in the UK for the final few minutes of my presentation. We're seeing very normal recessionary behaviour in the office leasing market. The chart here shows the amount of sublet space that is on the market in the central London office market. And you can see at the beginning of the first lockdown in March, there was about 3 million square feet of tenants trying to sublet space. As we stand today, there's now just over 5 million. This is very normal. This is companies saying, well, maybe we're downsizing, maybe we had too much space. Let's put some space onto the market for a shortish sublet and see if anyone bites. Most of this space is available in small chunks. Most of it is available for relatively short periods of less than 5 years. Most of it will not let or be quietly taken back by the tenant. But it does have an impact on market sentiment. There's no surprising changes here in the context of the new normal, very typical story. And I think the key point to make in the context of the sort of theme of this sort of overall event of a tale of two cities is that, this is very much a London story. We're not seeing that level of subletting in the big UK regional cities. What we are seeing everywhere is lower leasing activity, a delaying of development starts as developer confidence weakens. rising vacancy rates, and a little bit of downward pressure on rents, more on net effective rents than headline. But the important point to make, compared to the global financial crisis, very, very limited landlord distress, and we do not expect to see a lot of distressed selling in the offices sector. But again, I think probably the story about the regional markets being a lot more positive. Just looking at London, there's always the perception that you know, from international investors in particular, that London is very, very dependent on finance and insurance. So I thought I'd put this chart up. This is total office-based employment in the key central London boroughs. The bottom bit of these bars is the employment in finance and insurance. And actually, this hasn't risen at all. It's been on a gradually declining trend since the global financial crisis. But you can see, actually, you know, other sectors are far more important to the London economy than finance and insurance, at least in employment terms. And employment ultimately relates to office demand. And it's this steady growth in information and communication, professional science and technology that we think are going to drive the London office market going forward, and indeed have driven it over the last 5 to 6 years. So actually, we think London is comparatively well insulated against both Brexit and indeed the COVID crisis. In the markets we've seen in London, we have seen a significant downturn in investment activity. Right over on the right here, you can see the total volume of office investment into central London offices in the first 3 quarters of this year. It's going to be a slightly better year than we saw in the nadir of the global financial crisis, but not a lot better. The dotted line is the important one, though. That is the proportion of all the investment that was by non-domestic investors. So no real sign that non-domestic investors have lost faith in London offices. And again, I expect that line to actually rise quite substantially back up to 75 to 80% next year as it becomes easier to travel. If you are looking at London offices, this is a really positive story coming through here. This is the total volume of tenant requirements in the London office market. And you can see, very surprisingly, that the volume of requirements has actually risen this year rather than fallen. These are relatively big requirements. Many of these companies are looking for 50 or 100,000 square feet. They're big corporates, particularly in the legal sector and the tech sector. So, you know, companies still clearly saying, you know, London is where they want, in many cases, their European headquarters to be, clearly committing to headquarters or want to commit to headquarters buildings going forward. In the regional cities, and these are the sort of big regional cities over, you can see in the key on the right, the story is a little bit more resilient. The regional city office markets tend to be less volatile than London, primarily because they're smaller. Leasing activity in all of the regional cities added together to the end of the 3rd quarter, around 40% down year on year, whereas London is more than that. So there is a bit more of a defensive story in the regional city office markets, leasing activity not having fallen back. I think the key reason why the regional cities will outperform London over the next few years is there is a real shortage of grade A office space in those markets. So these bars show how many years of grade A supply there are in that market based on normal levels of grade A take-up. In the UK, a reasonable metric is to say if there's less than 2 years supply of grade A space, the market is undersupplied. You look over on the right-hand side of this chart, you know, there are a number of UK cities with less than 6 months supply. And I think tenant demand post-crisis will swing even more heavily towards grade A. Businesses will be looking for buildings that are safe, secure, support staff, wellness, have an environmental sustainability tag, are easy to get to. All of these factors will mean actually heightened demand focused on an undersupplied segment of the market. So I think there are development opportunities when confidence comes through, because there is relatively little of this space coming through in the market. The less positive story in UK real estate is around retail. You know, we have seen a massive swing away from bricks and mortar retailing in the UK to online retailing. Still 80% of everything we buy is through shops, or at least it was before the COVID crisis. And the chart here shows footfall across the UK compared to the same week the previous year in various types of retail assets. And you can see here in the slightly thicker line at the top, retail parks, which generally sell sort of bulky goods like furniture and floor coverings and fridges, recovering much better. They tend to be big units. They tend to have large car parks. And they are relatively back to normal because I think they are good socially distanced shopping experiences. Retail in the centre of cities is being really challenged by workers not returning to the office. And actually we're seeing the phrase in the market is donutting, so a hollow core of poor retail activity, but where people live, retailing is recovering better. But retail is a very challenging sector in the UK at the moment. We do expect to see further retailer failures. We've seen quite a lot, particularly in the sort of mid-priced fashion sector, as cannibalization by online continues. Real questions about Christmas this year. Will consumers loosen and celebrate a bit and spend a bit more, or are they worried about rising unemployment? And again, for those of you who are looking at the UK for the first time, turnover rents are relatively uncommon in the UK, but this crisis has led more tenants, more retailers to start to ask for an element of turnover in their rent. So if they are not performing well, they don't have to pay quite so much. It's just a new nuance in the market you need to be aware of. Just a quick word on hospitality or hotels. Again, very similar story to retail. This is looking at hotel occupancy across Europe and various other various regions of Europe. We were just starting to recover in terms of hotel occupancy. Hotel occupancy at the sort of nadir of the crisis was only 10% of normality. It recovered to about 42, 43% of normality, but lockdown 2.0 was not that back. And I think hotel market's expected to remain very challenging for the next 6 to 9 months. However, we are seeing hoteliers opening new operations. There is a belief that not only business tourism but consumer tourism will recover. I think they're probably right. I suspect business tourism is likely to recover less strongly than consumer tourism next year. The one sector that hasn't been behaving in a normal recessionary manner is logistics. And again, this is not a story unique to the UK. You will be familiar with this globally. These bars look at the total volume of logistics leasing activity where the warehouse is 100,000 square foot or more. And you can see right over on the right, the total volume acquired in the first 3 quarters of this year was the highest level ever reached in a full year prior to that. So it's been an astonishingly strong year for the logistics leasing market. Many global investors went towards a sort of a logistics focused strategy 2, 3, 4, 5 years ago, and are quietly rubbing their hands at this. This has been heavily supported by COVID-19. More and more people shopping online has driven significant demand from online retailers. Not just Amazon, but they have been very active in this market. So it's very strong market. There are big regional variations. If you're looking at the UK, the absolute heartland typically for UK logistics leasing activity is in the Midlands. So you can see here in the chart on the left, the East Midlands being the most active market this year. And so again, you need to sort of pick and choose your locations if you're looking at UK logistics. And generally the middle of the country is the most popular location. For us, there is a sort of second very strong bubble in the market around London. So the M25 is the orbital motorway that goes around London. That's probably the next most popular location for many logistics operators. Popular, however, is a challenge, and this is looking at sort of prime logistics yields in the UK, which have reached some time ago record lows and remain at record lows, potentially with some further downward pressure on yields. This is an incredibly competitive asset class. Back at the beginning of 2018, for the first time ever, logistics yields in the UK were lower than retail yields. I don't see this story changing, but I think you have to pick and choose your asset very, very carefully, because we are starting to get to the point of the cycle, I think, where you question whether some of the yields being paid are justified by the forward rental growth path. But I think there's nothing wrong with this sector. Incredibly long leases on offer. If you buy a big warehouse in the UK, you will probably get a 20 to 25 year lease. The rents will be reviewed, as I said earlier, only upward or flat or upward every 5 years. And the covenants in this sector will be covenants in many cases that you're familiar with wherever you come from. So, Amazon are the single largest occupier of warehouses in the UK. So just wrapping up, I think we're going to follow a very normal post-recessionary pattern with one or two new wrinkles. There's going to be very limited development activity, significant lender caution. Retail, I think, is going to remain highly challenged and highly specialist in the UK. And if I was looking at retail at the moment, I would be asking, can I repurpose it? Can I densify it? Can I put apartments on top of it? There are significant numbers of global opportunistic investors looking at retail at the moment because it's so cheap, and they're just starting to take the view that with prices having fallen around 50, in some cases 75% over the last 4 or 5 years in UK retail, some of the best assets could well be a buy. But this is not a hunting ground for non-retail experts. It's still a very challenged area. Offices, I think, will remain the biggest segment of the market. Some investors questioning whether they are as core as they were in past cycles because of the home working phenomenon. Our research says that the majority of people in the UK want to return to the office for the majority of the week when things improve. They will work at home a little bit more, but I don't think this implies a massive reduction of demand for office space. And we came into this crisis with a real shortage of grade A offices in the UK. Grade A offices, green, sustainable, new, again, very similar stories internationally. They will outperform going forward. Logistics, I just mentioned, is probably the world's most popular asset class. It will continue to be so and will continue to be keenly priced. Probably more of a development play for me at the moment than an investment play, just because pricing is so keen. And finally, alternatives becoming increasingly core. A significant number of our global clients now have what they call a beds, meds and sheds strategy, sheds being logistics warehouses, anything with a science tag, anything with a data center tag or an internet shopping tag, very popular. And I think that's going to become increasingly core. It will probably be the second biggest asset class across Europe after offices going forward. Thank you very much. I hope this has been interesting for you. I look forward to receiving your questions when we have our Q&A session later on in the week.
Thank you for watching today's session. Do submit your questions on the link below, and we will strive to answer all of them during the panel discussion, which will be conducted in Zoom on 21st November at 2 p.m. Please tune in then, and we will see you tomorrow.